All right, we're happy to have joining us Jürgen Hendrich. Is the CEO of MEO Australia Limited. It's traded on the ASX. The symbol is MEO. Welcome.
Thank you, Stu.
I may need a little more familiarity with the stock exchange and what you do, because we're talking about a good distance here. Give us an overview of the company.
An overview of the company in 25 words or less. Stu, where are you? Probably less. Thanks. We're an exploration stage company for conventional hydrocarbons. We've got a gas-based portfolio. We're on the doorstep of Southeast Asia, which, as you know, Stu, has an insatiable energy appetite. And Australia is growing to be the number 2 LNG exporter in the world over the next 5 years from sanctioned LNG projects. So we're playing in that space.
Well, you're playing in a highly demanding space with a necessity, since alternative energy just hasn't really cut it. And I think one of the problems is we're not there yet. It's not that there's a knock against it. We're not there yet. But we're there with gas, with oil, with coal. Gas, an important component, is one of the real problems transporting it, and that's where the basic nature of gas, the issue lies.
Absolutely, Stu. To transport gas, essentially you need a pipeline, or if it's long distance, you're talking about liquefaction of the gas. And the predominant product of liquefaction is LNG, liquefied natural gas. There is another product you can make called methanol, which is predominantly a chemical building block, but increasingly is an energy product in its own right. The benefit of methanol is if you've got CO2 in your gas, methanol benefits from having 25% CO2 in your gas. So it's a lot cheaper way to make to liquefy your gas than LNG.
I'm not sure how to phrase this question, but conceptually, when we think of gold and silver and some of the precious metals out there, you can get a clear picture of what it is and what you're dealing with. Could you perhaps translate that to an audience who may be unsophisticated in looking at your site and looking at what you have to do in the extraction process? Just giving us a synopsis of it.
That's a tough question. We explore for conventional hydrocarbons, pretty simple stuff. It's what you do with it when you find it that makes the key difference. And you said if you're in the gas business in a remote place like Australia and you need to get that gas to market, you have to liquefy it. Folks it's basically a big refrigeration process. So the more gas you have, the more chance you have of monetizing a gas resource. It's not a question that's easily answered in a 30-second grab, but what we do is look for resource potential in areas that may be overlooked. We as a small company can compete only on our technical capability. We certainly can't compete on balance sheet strength when you've got the gorillas out there, the mega majors that have that advantage. But our advantage is speed and our technical capacity. So we bring the best minds available to the company and get their shoulders and their intellectual horsepower to the wheel. So coming back to your question, gold, silver, LNG, hydrocarbon, energy there's an insatiable and growing demand for energy, and we're playing in a very small niche market that is looking to supply gas to Asia.
You think of the duality, and it's more complex than that, but the duality of industry. I think of the pharmaceutical industry and medical discoveries. You've got to be financed, and then you have to think about carrying on with the research to get FDA approved. Where are you in the race in terms of having the appropriate capitalization and the time limit in order to abstract your resources and turn this into a profitable venture?
The beauty of the business that we're in is that there are multiple exit points, just like your pharmaceutical industry. we're an early stage company, and if something has more value, if a resource that we discover has more value to the majors than us hanging on through that difficult period that Randall this morning called the orphan period. Post-discovery, pre-development is a period where shareholders lose patience and leave your stock, so you suffer that lack of momentum and the value disconnect there. We're pretty focused on finding hydrocarbons and attracting the majors into our business. So we're happy to spend a little bit of capital up front, say on acquiring acreage, acquiring the imaging to help us see the prospectivity, and then we seek to recoup that sunk capital cost when we bring in partners that have got the deep pockets. So our business model is to recoup those sunk costs as early as we can, not expose our shareholders to that high capital cost of drilling, and the transactions we do with the majors, we back-end load those transactions so shareholders are shielded from that capital spend for a lot longer than is normally the case. And at the end of that period of evaluation, that resource has been defined, and then we're in a position to monetize it or develop it, depending on what has the most value for shareholders.
Jürgen, I go for my physical once a year, and you know what the last question I ask my doctor is? What should have I asked you that I didn't? Jürgen, Hendrich, what should have I asked you that you'd like to answer?
What should have you asked me? I think
Toughest question of all,
I think the burning question, the elephant in the room is we've got 90 million in cash. Our market cap is 92 million. I've got 5 discoveries. Where's the disconnect? That's probably the question. And to me, the disconnect is as a company without cash flow, we're basically trading in asset valuations. And we're in a period where unless you're actively drilling in Australia, the attention span of speculators is quite narrow. And so we've fallen through the cracks because we were not actively drilling this year. However, we've got a big 2012 coming up.